Welcome back. Today we're going to talk about some historical social sentiment data from Financial Modeling Preps API. And I've written an article about this recently, so if you've seen that, this is going to be essentially a walkthrough of what we're doing in that article, just with a person telling you what's going on instead of you reading it word for word. All this code is posted in gists. So if you would like to see the code, there will be a link in the description below to the article, which has all of the code therein. But this API I've been using recently to test a whole bunch of different social sentiment relationships with financial variables, and I really enjoy it. It's very easy to use. Highly recommend you check it out. There will be a link in the description if you're interested in accessing it. But they got a ton of data, so if we head on over to the documentation, you can see all this stuff over here. We have news, everything from news to analyst price targets to M&A, institutional ownership. I mean, tons and tons of stuff. Now, I will say the only downside to their social sentiment in terms of their historical social sentiment is they no longer have access to Twitter. Obviously, since the recent situation with Elon Musk, they shut down the academic version of their API. They shut down a whole bunch of access points, and there's only enterprise availability to a certain capacity every month. So the Twitter sentiment has been throttled, but a lot of research shows that the relationship between the StockTwits and Twitter sentiment are strongly positively linearly correlated. Not to say that they can be substituted with one another, but also not to say that that isn't also reasonable. But nevertheless, we're going to walk through essentially what I did in that article. What am I comparing? What relationship are we analyzing? And kind of where can we go from here? So let's just hop over to Jupyter in another tab. So here I am essentially analyzing the contemporaneous stock return for large cap stocks, large cap firms with the contemporaneous social sentiment. Okay, so what does that mean? So what I'm going to do is I'm going to use Financial Modeling Preps API, so FMP's API, to query the historical StockTwits social sentiment. All right, and the way I'm going to do that is I'm just going to do it with a loop, and I'm going to query a certain number of pages going back approximately a year or so, I believe. And that's this function that I wrote here. This is a helper function that I wrote for accessing their API. This is something that I'm considering baking into my Python package QFin, so if there's general interest, let me know. I can bake in a whole bunch of these helper functions, but that's an ongoing project. Okay, clearly I have not posted my API key. You would have to use your API key here to access this data, but essentially what's going on here is we're creating this helper function, and I'm creating a blank data frame, and I'm going to iteratively append the new social sentiment data to this data frame, essentially every query to this particular endpoint for social sentiment. All right. So using that function, what I'm going to do is I'm going to pass a whole bunch of tickers. So these are just arbitrary large cap tickers. I had ChatGPT generate this list for me. Obviously, you can use the R3000, you can use the S&P 500, whatever cross-section of equities you would like to use, you can use. I'm just using this as an example. And then what we end up with, once we actually go through and we run this historic sentiment query here, is a data frame that looks something like this. Okay, so we have, as you could tell, duplicate dates, right? That's because the posts aren't daily. They're more granular than that in terms of time, but I do cast it to a date. So if we wanted to do some intraday analysis, we definitely could, because it is, like I said, more granular than just the daily level. But I've aggregated to the daily level because I'm interested in looking at the social sentiment on the day with the returns on the day. Okay. Moreover, what you should probably do in terms of a trading strategy is analyze the pre-market sentiment. That is, so that the strategy itself is tradable, and then you would do this analysis in that tradable sense. In this context, I'm just going to do this as an example with contemporaneous return because it makes my analysis much easier. And I've already done this for pre-trading if you read my paper. we already find this relationship exists. So nevertheless, that's what we're doing here. This is what we end up with. We end up with a data frame of Twitter sentiment and stock twit sentiment. Surprise, surprise, Twitter sentiment is 0 because we don't have that data, but stock twits, we still have that data coming in. Okay. Now, it should be noted that I don't know the actual measure that's being used to construct this social sentiment. Okay. I do know that there is a positive skew to social sentiment and a negative skew to news sentiment. So that's important to note, right? So in general, social media is going to be arbitrarily more positive than, say, news. I mean, rationally, that just makes sense, right? Because you make more money on negative news stories than you would on positive news stories. It creates more of a buzz. But that's an interesting heuristic that we are going to essentially digress from and move on with this analysis. But it should be noted that I don't know formally how these are constructed, and I'm working with FMP to try to figure out, like more specifically, what data is being used to construct this sentiment signal here. But we can take this as an arbitrary measure of social sentiment at a particular time, okay? And we just essentially reduced it to that day. So we don't know what time this social sentiment is recorded for. This could be during market hours, before market hours. There could be some bias here. Obviously, a lot of look-ahead bias if we're looking at data past 9 a.m. and we're trying to trade at market open. We could have a situation in that context. Now, again, that's besides the point of this analysis. We're just trying to see if there's even any relationship at all between the social sentiment and the subsequent stock returns for that day for that particular firm. Okay? So what I end up doing is I just run this mega query here for all of the tickers, and I do it, you can see it's fetching for all the large cap tickers. I pickle it, so essentially I just serialize that particular list so I don't have to requery everything. I have a list of data frames as a result, okay? So that is the workflow here. I come on down here, and what I'm looking to do now is process all of these data frames. So what do I mean by process? Well, I'm going to do a group by mean on date and symbol, all right? So every day, I'm going to group all of the returns into that day, into that symbol, into that particular bucket of returns. So let's say January 2nd, 3rd, whatever it is, you give me a particular day. I look at the symbol and I average all of the returns on that particular day. Or rather, I average all the sentiment, on that particular day. So what that looks like is we could see here 11/23, 11/23, 11/23. That is Apple sentiment, right, at different hours essentially throughout the day for 11/23. So what I'm going to do is I'm going to collapse all of these down into one row, and I'm going to average the sentiment from all of these posts. Okay, so that's the fundamental idea there. That's a group by mean by date and symbol, and that's exactly what we have here, a group by mean. I'm going to reset the index and append it to a process data frame set, and then essentially I'm just going to construct a concatenated data frame, a pooled data frame of dates and symbols, so I can append the returns, or rather really merge the returns by symbol and date onto the concatenated data frame here. All right. I'm not using words. I'm not using any fancy pricing data. I probably should be. But I'm going to use Y Finance because it's really easy and it's free and everyone has access to it. So what I'm going to do is I'm going to take my large cap tickers and I'm going to define my start and end period for the pricing information. That is the return information that I'm trying to get here. So I'm going to go ahead and retrieve all that from Y Finance. Then I get this nice data frame here, this stacked data frame of tickers by adjusted close, open, etc. And then I have the date of the price, right? So I can construct daily returns with this. Stock data close minus stock data open over open, right? That's going to be the daily return. And then I'm going to reshape the particular data such that we can index by date and symbol. This is so that I can merge it with the original sentiment data, okay? So this is just bringing two data sets together, okay? And that's exactly what this merge is here. Funny enough, that was an interview question, the difference between a pd.concat and a pd.merge. One of them is going to essentially merge two data together. One of them is, going to concatenate two data together. Okay, so that's the difference. You may not be preserving the column space in the merge, is essentially what I'm getting at. So when you merge two data sets together, you can bring in new information, new features. When you concatenate, you're preserving the column space. You're not adding new features. If you didn't know. But I did get that correct. So fantastic. All right. Anyways, that's exactly what we have here, right? Because remember in our original sentiment concatenated data frame, we did not have any pricing information, right? You can see this. We have our date, we have our symbol, and then we have all of the sentiment information, and then the particular timestamp, right, that I extracted the date from. But we don't have any returns. But now if we scroll on down here, right, to where we merged it all together, we did not preserve the column space. That is, we have now a whole bunch of pricing information as well, right? We have our daily return, and that is exactly what we're looking for, okay? All right, so now let's look at a scatter plot of sentiment and return, okay? So this is a really interesting scatter plot. This is something that we would kind of hope to see, actually, in an initial analysis. Now, something that you might more intuitively expect to see in a scatter plot is something that's positively linearly correlated. That is, scatter of points that are kind of just going arbitrarily up together, right? Or maybe arbitrarily down together, whatever your prior is on this particular scatter plot. But this is something that we would kind of expect to see in the sense of trying to derive some sort of social sentiment trading strategy. Particularly because you could see that around neutrality, we have kind of a set of positive and a set of negative returns, because there is general confusion as to the classification of whether or not that day should be positive or negative. So this is actually kind of encouraging in a sense, because if this was just noise, we would expect, just a Gaussian cloud of points, essentially, right? There was no information to be extracted. But here, we can see around neutral sentiment, that is that 0.5 measure, we have positive, arbitrarily positive returns and arbitrarily negative returns. Now, you might be saying, hey, that's all nice and good, but why are the returns when sentiment's positive not arbitrarily positive? And when the returns are, or when the sentiment's negative, the returns aren't arbitrarily negative. And the answer to that is it's all relative. So what we're trying to do is a time variant quantile breakdown of the sentiment, so we could see if in general one bucket is higher than another in a long short setting. There are other aspects we have to consider, that is portfolio turnover, market frictions, whatever, blah blah blah. This is a very high-level model. I'm using Y Finance for pricing data, so bear with me. This is just a preliminary analysis before you would want to do some sort of deep dive backtest. But nevertheless, I get started with a time invariant signal. This is a lazy man's Quartile distribution. So what I do is I set n equal to 4, okay, and I'm going to create a bucket. I'm going to do a Q-cut on sentiment, and I'm going to look at the average daily return in each bucket. That's what this bar chart is. Okay? So what I'm doing is I'm taking the entire time series across all the symbols. This is a horrible way of doing it. Okay? This makes almost like no sense in terms of distribution matching and whatever, blah blah blah. This makes no sense. But essentially what I'm doing to see if there's a monotonic relationship between the trading signal, which is our sentiment, and the stock returns, I'm going to do a quartile cut. I'm going to bucket into 4 buckets. Sentiment, that's the lowest, 25th percentile. Then the next bucket goes to the 50th percentile, then to the 75th percentile, then to the 100th percentile. So that's essentially what we're looking at here, is if we bucket the social sentiment, what is the average return in that bucket? And we see something here that's kind of encouraging. No, not really. It is kind of encouraging to some capacity, maybe. Strictly because if you went short the bottom 50% and long the top 50%, you'd make money. You can see that here just by adding up these two legs and adding up these two legs. But this isn't what we would want to see in a trading signal. We would want to see a monotonic relationship between signal and that is if we really actually find alpha. If we find an inefficiency, we should see a strong monotonic relationship, right? So what I do then is a more intense analysis. That is really what I'm doing is I'm doing this quantile quantile cut, this quartile cut rather, this Q cut, right? We can do n equals 5, 10, 7, whatever you want. I'm doing this Q cut then every single day. Okay, and I'm doing a Q cut on sentiment, and then I'm doing a group by mean on the particular bucket for the daily return, and then I'm appending that to a dictionary, or rather a list of the bucket's returns. Okay. Okay. So what does that mean? I'm doing a group by bucket. So every single bucket, 0, 1, 2, 3. So right, we have bucket 0, bucket 1, bucket 2, bucket 3. I'm going to do a group by mean on bucket and daily return. So that means I'm going to essentially have a vector that lives in R4 of the mean daily return for each bucket. Then I'm going to append that to a set of datas right here. Okay. And then last but not least, we're going to take the mean across all of those vectors in the column space. That is, we're going to squash down, take the mean in terms of squashing down. That is, we're going to take the average of all the returns in the 0th bucket, take the average of all the returns in the first bucket, take the average of all the returns in the second bucket, so on and so forth. And hopefully we see oh, look at that, a strong monotonic relationship between the sentiment signal and the pricing information. Is this a shocker? Not really. There's a lot of evidence in the academic literature that suggests this sort of relationship should exist, even in a predictive capacity. This is contemporaneous, so this is not tradable, but this is not something that we should be surprised of. Honestly, we should be more surprised if we didn't see this relationship, especially because we're using contemporaneous data. Okay. So this is exactly what we want to see. What sort of portfolio can we construct? Well, let's go every day long the top bucket and short the bottom bucket. That is not based on this particular time variant series or time invariant series, but that is every day we'll do a Q cut and we'll go long the top quartile, and then short the bottom quartile. And this is the subsequent social sentiment trading strategy. Looks pretty good. Sharp at 2.3-ish. We annualize the return, annualize the volatility for the portfolio here, and it does a pretty good job. Now, this is contemporaneous. We wouldn't be able to trade on this. We would have to do more analysis in order to do so, to make it tradable. Okay? And then here's a joint plot of both of those beautiful charts. So where do we go from here? First off, thank you to FMP for sponsoring this video. Thank you for the access to your amazing API. I highly encourage that you check out their financial data API. It's super easy to use, and like I said, if there's general interest, I can make tools for that API for everyone. Okay, but where do we go from here, right? What are we supposed to do in terms of a contemporaneous signal with the relationship it has to the subsequent stock return for the day? Well, there's a lot of directions, right? The first thing that you would want to consider is perhaps you can develop a model that is predictive of social sentiment. Then you know if you can use contemporaneous social sentiment to trade on stocks, you can use your model to predict contemporaneous social sentiment, and then boom, you use that to determine your bins, and then you use that to determine what equities you trade. That's an option. Something else you can do directly right now is maybe you would say, hey, this is a contemporaneous relationship. What is the decay for this contemporaneous relationship? Do the returns hold for a 1-day window, 2-day window? What's my portfolio turnover? How many assets should I expect to keep in a portfolio? Does the signal switch often for particular assets? All of these are good questions to consider, and they're all topics for future articles and videos from me, depending on interest. One article that I'm currently working on right now is this idea of social sentiment and analyst price target spread. So taking a look at the relationship, does social sentiment correlate with the way that analysts set their price targets, or vice versa, right? This is in terms of a general correlation. There's no causal analysis going on here. All this is statistical. All this is general correlation. There is no such interpretation in this setting. Even in a predictive sense, not necessarily that any of it is causal. It's namely just statistical relationships, right? We're not doing any sort of regression discontinuities, any sort of anything to discern causality. We're just trying to examine statistical relationships right now to see if we can even get a ball going in a direction. But that's going to do it for this video. I hope you enjoy this walkthrough of using FMP's API to query social sentiment. Join it with pricing information, whether you get that from Y Finance, you get that from Words, you get that from anywhere else. And then taking a look at how we can create a time invariant and a time variant signal based on a Q-cut. Obviously, the time variant signal is more complicated in the sense that we're doing it on a daily basis, and then we're taking the average for each bucket in the entire time series. But this is exactly what we would hope to see in a promising trading strategy. And then subsequently our beautiful portfolio. So if you have any questions about this, feel free to leave them in the comments below. You can always shoot me an email, roman@quantile.com. Check out, once again, FMP's API. I'll leave a link in the description if you're interested. Check out our Medium. Check out quantile.com. We just launched our algorithmic trading course, developing an algorithmic trading system solely in Python. Other than that, thanks so much for watching, and I'll see you in the next one.